Hi guys, so today it's Christmas Eve, but I want to my goal is to provide as many different ways to trade. Some are more technical than others, but this one is going to be a way that I believe everyone can use going into the new year. Just stop trading altogether and just practice and look and just prepare yourself for the market next year. But I want to give you a easy way that I believe that you can take steps to become profitable. So this strategy is real basic. It's elementary, I would say. Um, I don't even have a name for it. It's just another strategy that it could be qualified under the keep it simple situation. Um, but this is how it goes. All right. So this is the you see how we're on a big boy time frame. If price goes, this is the moving average. Okay, this is what you need. If price goes above the moving average, you buy. If price goes beneath the moving average, you sell. Okay. Now here's the criteria. Price must close before entering a trade. All right. Now this is the month. Obviously, you can't wait to the end of the month, but price must close before entering the trade, and your stop loss will be the previous high if you are selling and the previous low if you're buying. Okay, that's your stop loss. All right, now this is not a super crazy accurate strategy. It's probably like 70%. So out of seven out of 10 trades, you'll get them correct. You'll get the trade correct. Um, and they're good. You need a minimum of one moving average. I use the 50. And it's best for the H1 time frame and higher. All right. Now you can use it on the smaller time frames if you want to scalp or whatever. But if you want to get the most out of your trade, that you can hold it for a day or so, or hold it for some time where you can see the visualization of everything. Then you trade on the H1 or above. Okay. H1, each candle is an hour. H4, each candle is 4 hours. All right. So for example, anywhere. Like for example, if you don't like if you for this day, we're gonna zoom in because you can zoom in on this situation here. Price goes beneath, but it doesn't close under. All right, so you got to be patient. You want to see an obvious candle closure under the moving average. Okay, and once the candle closes, you enter the trade and you hold the trade until you're satisfied or until price comes back above price comes to touch the moving average again, right? You can hold it. So this trade would have been either down here at its peak or here, right? Now it's one trade for about 2 weeks would have been 200 pips, right? But if you held it to the low, this is a trade you can just take and let it play out, 340 pips, right? And then you'll have times, and I want to show you also times where you may take a loss because that's just what it is. All right. So, but it's good to practice. The loss is not what I want you to focus on. The proper application of the strategy is what I want you to focus on. Being okay with the probability of success, because there's no way that you can when you're not okay with the probability of the success of your strategy, you tend to fight the strategy and you fight this probability. So the 70% that was supposed to work for you ends up becoming 30% because you're forcing trades as if you're not supposed to lose at all because you're breaking the strategy, right? So price comes to close above it, right? You buy. You put your stop loss here, right? So a 50 pip stop loss, right? You would have lost that trade, but it does it again, and you won. You made more than you lost, right? So there's opportunities where you will take a slight loss, but you will always make that back if you follow the strategy, right? For example, here's another one. The price closes under. That's a good. That's visible enough. And if you didn't get out, if you wanted to see it come down, you put your stop loss above this candle, which is the previous high, and it comes and stopped you out. But in the interim of it stopping you out, it also gave you a strategy, another entry, because it came above it. So while you may have had this stopped out, you would have got another entry here and made all that back. Okay, so like I said, you're going to take some losses, but you're going to make that money back, right? And like I said, it's about the 70 to 75% win to loss ratio, and it's just good. It's good to have something that you can work, especially in the range. You got something like this, it closes here, and obviously this 4-hour candle has obviously 1-hour entries that will be better, but it helps you. It helps you. You say, well, if I just want to trade on a 4-hour chart, I don't have much time in my week, so let me see what I can do. I probably can get about 1 or 2 trades a week because of my schedule. 1 or 2 trades a week because of my schedule. So you see this, it closes at the beginning of the week. You enter here, you put the stop loss here, you go about your day and make 90 pips, and then it comes back at the end of the week, and you see this movement. It closes, you enter here, and it gives you all that play, right? So it's not about these strategies that I'm giving you, that I've been sharing, are not just about having a bunch of different ways to trade all at once. It's to give you different options that you can use to include an extra stream of income within your schedule, regardless of your lifestyle, regardless of your availability to the charts. Because what I saw when I first started to do this in 2020, when I began, I had a nice size group and everything. But what I noticed, that for me it was draining, because I was putting myself under so much pressure of being up at London, being up in New York, being up in London, this is for days, because I was doing live trading sessions every day with my group, to the point where it was taxing on me and therefore on my family. And so now, as I'm looking at what I'm seeing now and I'm showing now, it's just good to have different ways to accomplish the goal, to remove every excuse as to why you can't. All right. So this is why I'm giving you this. Now, obviously, you have people who want to trade on the daily. I understand. So you want to get back to the 15-minute chart. Now, with the 15-minute chart, you have to be anything less than the hour chart. You have to be on it. Like, you cannot take the chance of trading and forgetting about it, because if you come back the next day, depending on what trade you took, it may be detrimental, right? That's why I was saying, as far as this strategy, you want to trade the hour or higher, because it gives you that freedom to not be boxed into having to look at your charts 3 or 4 times a day, depending on how long you're holding the trade. So if you're going to trade anything less than an hour, you gotta be able to watch it. If you got to work, don't trade doing your job. Don't trade doing your job hours, because that creates a whole different level of pressure, and unnecessary level of pressure and frustration. I can't tell you how many times I've traded and lost trades when I should have been focusing on the other priorities that I was already involved in. I'm trading and I'm taking my kids to school, take a loss because I should have been focusing on spending time with them instead of trading anyway. But I take a loss and I'm taking it personal, because I put myself in a place of distraction. Whereas had I just waited, even if I missed the trade opportunity, I would still have the capital to trade in another opportunity. But nevertheless, all right, here's another one. All right, now you see my calendar, my chart is way back, because I like to go back and check out things. So you have this one right here. This one would have actually been profitable, right? And then another thing with these trades, every trade is not a breakout. Every trade is not a breakout trade. All right, so be satisfied with what you get. If you can get 20 pips, be satisfied with that. So you see this trade, you enter here, you put your stop loss there, and you got 20, 28, 25 pips. Take that. Don't be like, well, I want 100. Okay, well, it's already on an upslope anyway, because of the slope of the moving average. So you can't get that much movement against the moving average angle. So don't you got to be logical with what you already know, right? So the moving average angle is already heading up, and you get a break of structure, a break of the moving average, which is a structure at some point, which is structure and it's a form of structure. All right, you get a break, all right, it closes, and you get some push down. you can take that, understanding that that's not the true direction anyway. This prepares you and gives you a little bit more capital for this. So if you made 25 pips there, you wait for it to close and you get that. Right now, you get that. So you made 25 plus 220, that's 245 pips, right? You leave all this alone. We use the moving average as a place of comfort, because we know that price has to come back to the moving average, right? So you wait for it to come to the moving average, or wait for it to break the moving average for you to decide what you're going to do, right? So it breaks, it closes, right? You put your stops above here, you get your pips, right? So you put your stops here. It may have stopped you out if you held it long, right? So you may have took a little loss there, but it comes and does it again. It comes back under, enter here, and it goes down. That's 100. You made more than what you lost. All right. It breaks here. It closes. Now, obviously, you know that it's a down slope. So we don't want to make a habit of trading against the trend until the trend shows us that. That's another thing. Every break of the moving average is not valid. A break against the moving average that is against the line, you got to know that's a stop hunt, right? We talked about M's and W's before in the other video. The second leg of the M or W was the most exaggerated, right? So this is a W. This is the initial leg. The second leg came back to give you this fake out, and that's why I pushed up like a bow and arrow, right? So there's a first leg. It came down, pushed up higher, and then pushed down lower. So you have to look at that. But that's another thing. You want to take these trades in line with the moving average slope. So if the moving average slope is down, then you want to see price break down. If the moving average slope is up, then you wait for price to break above it. That's a big helper. Now, you do have the more experienced traders who understand what I just said, and they're able to play both sides of the moving average regardless of the slope, because they've seen it. They know the game. They know that they have the exposure to handle taking that risk. All right. But for those who don't want to get that, who don't want to get to the point where they just want to make money, they want to have something that's simple that they can count on, trade in line with the slope. So if it's going up, you leave everything that's going down alone. If it's going down, you leave everything that's going up alone. Now you will have the sporadic shifts like these, right? You still leave it. If you don't understand what's going on according to another strategy that I'm not going to confuse you with, you leave it alone. Just let it play out. If the slope is up, you trade up. If the slope is down, you trade down. Trading up means you wait for price to break above it and close. Trading up means you wait for price to break above the moving average and close. Trading down means you wait for price to break under the moving average and close before you enter the trade. That's as simple as that. All right. So you will have things like this that are valid. They broke up, but you still want to wait until price breaks up. All right. This is the middle of the letter. You got this come down, right? Because you got to be able to see these things without always having to mark up the charts. Because you don't have that. Most people don't trade in front of the computer. Most people trade on the go, right? You don't have the luxury of marking up your charts on the go. So if you see the moving that you want to see moving average angle going up, now you say, okay, I'm looking for price to break up, and I'm using the previous low as a stop loss, right? Let me close these, get rid of these objects, because this stuff, it works. You got to just take everything we know and make it make sense. So if you wait and you wait for it to break above and close, right? It closes here. You enter. That shouldn't have been it. I wanted it to be a line. It closes there. You enter. You put your stop loss here. Previous low, which is the low of that candle, right? It goes up. There's nothing else to worry about. You don't have to worry about, it may pull back. Even if it pull back, the slope says it's going up, right? It's like an escalator, right? I don't care. You put your foot, you raise your foot, you put it down. If this is what's keeping it up, or this is the pathway of where price is going. Let it play out, right? I think about how the Bible says, "Let patience have a perfect work, that you may be entire, wanting nothing." Let the trade play out, that you may not be so fidgety and trading buy and sell, buy and sell, buy and sell, and you end up blowing your capital trying to get all these little bitty moves, and you end up worse than you were when you got the trade right to begin with. Let the trade play out, that you may have the ability to get the entire move. Right? That's 400 pips without back and forth. Right? That's real simple. Right? So you got moving averages, and you look at the moving average slope. It begins to kind of go around. Right? So instead of you looking for a double top at the high, which people have the ability to do, just stick to what's working for you. And if you have the desire to learn more by practice, not by experimentation. You practice on demo account. You experiment when you take your real capital and do what has not been, what you haven't tested, to see if it works for you. Which if it does work for you, it gives you a false hope, because you don't have the understanding to support the win. If you don't have the understanding that gives you the ability to reapply that same principle again to win, you're experimenting. You should practice before you apply something, especially when it comes to your money and your capital. Right? So if you don't know about if you're not sure, just the slope it'll show you where it's going. Right? It'll show you where it's going. So if you wasn't sure here about if it's going up, let it go, let it play. By the time you get to here, you will see this at this point is higher than the previous point. So this is saying I should be looking for a buys. I should be looking for price to break above the moving average before I enter the trade. Right? So you enter the trade, you got 30 here. It's still going up even with this pullback. Right? It's still going up. So you wait again. It closes above it. Boom, 90 pips. Right? You don't worry about this, right? Why shouldn't you worry about this? You shouldn't worry about this because these type of trades are for the more seasoned trader, for one. And then it's like I said before, it's not always guaranteed that you're going to get this trade right. Imagine it breaking through as such and then continuing up like this, right? You don't have that. You don't have that understanding. The moving average at that point is still pointing up, right? You don't have anything to tell you that it's going to go this low. This move is technically stop a liquidity grab from all these lows that were engineered into the trade the day prior. This one move took out all of these lows. Why would they come and get all the money from these lows if they were going to continue to go higher, go lower? The moving average does not support this move. This one doesn't even curve down until here, right? But when it curves down to here, it slowly goes up. So after this trade, for this strategy, you shouldn't have been trading anything else until you see the moving average give you a clear direction, which came the next day. When it went up, and then over the course of this time frame, it went up again, right? It came down, it touched the move, it came a little bit beneath it, closed above it, right? You got this trade. So if you use this low as a stop loss, you already would have got stopped out. This is it. Hey, you can't foresee this. You can't foresee that type of grab. Okay? So what? You got another opportunity. Moving average still going up. It came under, it closed above, you get back in, you made that money back. You can't be perfect. It's not going to be a perfect situation, right? So, and that's, like I said, that's the 15-minute. But if you were on the 1 hour chart at that same time, you probably wouldn't have got stopped out, because you would have got in here, and your previous low would have been here, right? You get a better sweep on the bigger time frames, and you get less. There's less probability of you being stopped out, because the moving average is not as active on the bigger time frames. All right, so let's just look at. I'll I want to go to see how this applies to Bitcoin, and I know it's going to do great for Bitcoin as well. Like for example, this is on the 1 hour chart, right? The slope is going down, so you're going to be looking for down trade. This is a perfect example right here. Let me zoom in. Price closes under. You enter the trade. You put your stops above here, and this one trade was good for about 4,000 pips. You had the double, the second leg the next day, but I would say about a day and a half. You take that trade around like maybe what time is that? So that's this GMT time is 6 hours behind. So that would have been about 8 o'clock. From 8 o'clock to what's 13? 13 is from 8 to 1. From 8 a.m. another 8 a.m. to about 1, right? So from 8 to 1, 8 a.m. to 1 p.m. the next day. That's a good trade. Like I said, but this is the 1 hour time frame. Here's another one where it goes up, and you was good for a minute. It goes under, and you was good for a minute. So that these so-called volatile pairs, when you get the big moves because of it being volatile, and you don't have to take so many trades because you have this strategy that you have applied, whatever, you get the benefit of the movement without the frustration of not knowing how far it's going to pull back when you counter trend trade. You just get to enjoy the ride. All right, so let's go to the 4 hour chart and see, even on the 4 hour chart, right? Moving average was going up, price breaks under, closes above. That one trade was good to the high of the third week. So that's what 16,000 points, which is $16,000. So that would have been 1,600, 16,000 if you took a 0.01, 160,000 if you took one standard, and so forth. You don't need to take every trade. You just need to take the best trade, right? That's all you need. You need the slope to confirm some things, and then you need the entry based off where it's going. If you don't know where it's going, let the slope tell you. All right. Even on, let me go to I think this is called the slope. Yep. Even on the less volatile pairs, right? Same thing. The less volatile pairs are even more so better because you get into the bigger trades with less money. NGD, in New Zealand dollar versus US dollar. The margin is it's $12.50 for a 0.1. It's $1.25 for a 0.01, which is a dime per pip. And for 10 standards, you need, for a standard lot, it's $125 for a standard lot. For 100 with 10 standards, which is $100 a pip, that's $1,250. So with $2,000, you can take a trade on NZD USD and make $100 a pip. $100 a pip on NZD USD can change anybody's life. Let me just give you an example. All right, still the same patience. Right now, this is the daily chart. It's the same patience. Right now, the daily chart, each candle is a day. These vertical dotted lines are a month. So you see the slope is down. You have patience. Price goes up. Price closes. You enter in this trade. Right? So the high is 80 pips. So if you have $2,000 with 80 pips, 80 pips, you can't afford to take a $100 trade, but you can take a $20 trade, which is 2 standards, right? 2 standards. You get in right here, right? This one trade to the low of the month, which is here, that's 2,400, right? It don't seem like much, right? But it's one trade for a whole month. You hold that trade to here, that's $6,000, right? $6,000, one trade in 3 months. Don't seem like much, right? But let's say that's up the ante to 20,000. So 20,000, that one trade would have been a $200 trade, and that would have been 60 grand. One trade for 60 grand in 3 months. And most people don't make that a year, right? Can you get 20,000 off of 2,000? Absolutely, right? So that's just 3 months out of a year, right? So let's go to GU and see the same thing. So I'm gonna change it to my slope template, and let's go to the 4 hour chart. 4 hour chart, all right? 4 hour chart, GU, okay? Let's go to, now these things are where it don't even, okay, here's another one I want to say, because I've been trying to figure out how to communicate this. If you see that the price is under the moving average, right, and you don't get, it's slope already. There's no price above it, there's no push above it, but it's sloping down, okay? If price breaks structure, you can enter in at the close, all right? If price breaks a previous structure point, already heading down, you can enter in once that candle closes. And you put your stop at the previous high. So here's a low, right? Price breaks that. Once it closes, you enter here, put your stop loss here. You got a 70 pip stop loss, and you let that thing go all the way down. So for 2 weeks, 240 pips. So that's like a 1 to 4, right? 240 pips. Now with GU, it's I think it's like around about $3. I think it's like 258 ish, but I would say round it up to $3 for the 0.01. So if you had, let's say for instance, you had that same 2,000, you had the same 2,000, and you wanted to get in this trade, what could you do? Well, obviously the safest bet would be, I would say probably put your stop around. I mean, put your lot size around. Because I wouldn't do 200. I wouldn't do a standard lot because that's too big. That's like 200 pips. You don't have 200 pips of movement in 1 week for the most part, right? So let's say you did it for the 100. Let's say you did it for the 100, which is, so your lot size is 20 is two standards, which is $20 a pip, right? So you put your that's not your entry. This is the break of structure. Your entry is actually right here. You enter here, you put your stop loss here, right? So that's about a 60 pips. So you're risking $1,200 out of that 2,000 to make 4,800. This is weeks. This is not months, right? This is a little bit more volatile than NU, right? So you risk 1,200 to make 4,800. That's a 1 to 4, right? And that's in a week, right? So now you up to 6,800, right? Now you don't see any slope movement, right? Everything is sloping up, but you don't really have anything that you can say, okay, this is a good trade. You want to see price gives you something different. So you wait a little bit longer, all right? Price breaks above this, you don't really get much slope. You get slope here, all right? Price is already angled up. We got a slight structure here. Price breaks it, close above it. Now you have $6,800. $6,800 is enough to take, on GU is enough to take $100 a pip. So you enter there, put your stop loss there, and you let it go to the top. That's about between 12,000 to about 15,000 at the high of the week. You took one trade for 2 weeks, you held it, you waited till price till the moving average gives you a visible slope, and you got in here. Right? Seems a little risky, but that's what you want. That's what you have. This was a spare 2,000. The goal was to take that 2,000 and turn it into 20. Right? So now, with 2 trades, you go from 2,000 to 20, about 18 to 20, 21,000. One trade here, another trade here. May have took you some time. Totally 1, 2, 3, 4, 5, 6 weeks but only out of those 6 weeks you took 2 trades based off this strategy. All right. So like I said, it's not hard. It's just what do you want? What do you want out of the market? And then what is a strategy that you can use that is simple enough for you to repeat? And that is the probabilities of the win to loss ratio is high enough for you to be okay with losses that you may take following this strategy. This is a very simple strategy. Anybody can do it. As I said before you take live trades, if you don't have enough experience or if you're not confident in what I just shared with you, please don't experiment. Practice. Do it on demo account, right? You don't have to experiment. But that's all I have for today. I guess I'll entitle this video a simple slope strategy, and then I'll post it to my YouTube channel, and then I'll share it to my Facebook page. But that's all for today. You guys have a Merry Christmas and a Happy New Year, and look forward to making more videos as the new year progresses. All right, y'all have a good one.